What if I told you that one of the most important market signals for US and UK investors right now isn't coming from Wall Street or the City of London, but from Canada? While most investors are focused on Federal Reserve statements, UK inflation data, and big tech earnings, Canada's market is quietly flashing signals that could shape the next major move in global portfolios. And if you understand how to read those signals, you can position yourself ahead of the crowd. Instead of reacting after the fact, let's begin with the foundation. Canada's stock market, tracked by the S&P/TSX Composite Index, is very different from the S&P 500 or even the FTSE 100. The Canadian market is heavily concentrated in financials, energy, and materials. That makes it far more sensitive to global commodity cycles, interest rate shifts, and housing conditions. In other words, Canada acts like a pressure gauge for the real economy, especially when it comes to oil, metals, banking stability, and consumer leverage. When Canada moves decisively, it's usually not random. It's responding to something fundamental. Now let's talk about energy, because this is where the story gets interesting. Canada is one of the world's largest oil producers, and its economy is tightly connected to crude prices. When oil prices rise, Canadian energy companies typically rally strongly. When oil weakens, those stocks often feel the pressure early. Why does that matter for U.S. investors? Because energy prices directly influence inflation expectations, and inflation expectations influence Federal Reserve policy. If Canadian energy stocks start trending upward while oil stabilizes, it could signal that inflation pressures may remain sticky. That could mean higher for longer interest rates in the United States. For UK investors, energy is just as critical, since the FTSE 100 has major exposure to global oil and gas giants. A shift in Canadian energy performance can quietly confirm broader commodity momentum before it becomes obvious in London markets. Next comes the banking sector. Canada's financial system is often considered one of the most stable and tightly regulated in the world. A handful of major banks dominate the system, including Royal Bank of Canada and Toronto Dominion Bank. Because the system is concentrated and transparent, stress tends to show up clearly in stock prices. If Canadian bank shares begin to fall significantly, it may reflect concerns about loan quality, housing exposure, or consumer credit. For U.S. investors, that could serve as an early warning for regional banks or broader financial stocks. For UK investors, where financials also carry heavy weight in the FTSE 100, weakness in Canadian banks could mirror risk-off sentiment spreading across global financial institutions. And then there's housing, arguably one of Canada's most important pressure points. Over the past decade, Canadian home prices surged dramatically, fueled by low interest rates and strong demand. That has left households carrying relatively high debt levels. When interest rates rise, mortgage costs increase, and consumer spending can slow. If Canada's housing data weakens, or if bank stocks tied to mortgage lending start declining, it may signal that rate pressure is finally hitting the consumer. That's important for US and UK investors because both economies also rely heavily on consumer spending. Canada can act as an early stress test for what higher borrowing costs might do elsewhere. Markets add another layer of insight. The Canadian dollar tends to rise when global demand for resources is strong and fall when investors move towards safety. If the Canadian dollar strengthens alongside steady commodity prices, it may indicate improving global growth expectations. If it weakens sharply, that can signal risk aversion building beneath the surface. For U.S. investors, currency movements affect multinational earnings and trade competitiveness. For UK investors, shift in commodity-linked currencies can influence broader European capital flows and global risk appetite. Trade relationships also matter. The United States is Canada's largest trading partner by far. That means Canadian export data can sometimes hint at shifts in U.S. demand before they fully show up in American reports. If Canadian manufacturing or export numbers slow unexpectedly, it might reflect weakening U.S. consumption or industrial production. On the other hand, if Canadian exports accelerate, it may confirm underlying strength in North American demand. UK investors should pay attention as well, because global trade momentum influences commodities, shipping, and multinational earnings that impact London-listed companies. So what are Canada's markets signaling right now? When energy and materials show resilience, it may suggest commodity demand remains intact. When banks remain stable despite high rates, it may imply credit stress is contained, at least for now. But if cracks begin appearing in housing or financial stocks, that could be an early indication that tighter monetary policy is finally slowing the real economy. Canada often reacts quickly because of its sector concentration. That concentration turns it into a high sensitivity indicator. For U.S. investors, the takeaway is simple. Watch Canada to validate or question what you're seeing domestically. If American markets look optimistic, but Canadian cyclicals are rolling over, that divergence might deserve attention. For UK investors, Canada's signals can help confirm trends in energy, mining, and financial sectors that dominate the FTSE 100. It's about cross-market confirmation. When multiple developed markets tell the same story, the signal becomes stronger. The broader lesson is that global markets are deeply interconnected. Capital flows move quickly across borders. Commodities are priced globally. Banking risks can ripple internationally. By the time a trend becomes obvious in New York or London, it's often been developing elsewhere. Canada, because of its structure, frequently reflects those shifts early. Smart investors don't just follow headlines. They look for leading indicators. They compare sector performance across countries. They analyze currency movements. They pay attention to housing and credit conditions. Canada offers a compact, highly responsive snapshot of these forces in action. In today's environment, with interest rates elevated, inflation uncertain, and global growth uneven, ignoring Canada's signals could mean missing valuable clues. Whether you're building a portfolio in the United States or managing investments from the United Kingdom, understanding what Canada's market is communicating can help you manage risk, spot opportunities, and stay one step ahead of major shifts. Because sometimes, the most important signals aren't coming from the loudest markets. They're coming from the markets that move first. And right now, Canada might be one of them.